The going concern assumption is one of the fundamental principles underlying financial reporting and auditing. It presumes that an entity will continue its operations for the foreseeable future and has neither the intention nor the necessity to liquidate or significantly curtail its activities. Under this assumption, assets are recorded at their historical cost or recoverable amount through continuing use rather than liquidation values, while liabilities are settled in the normal course of business. ISA 570 revised, going concern establishes the auditor's responsibilities relating to management's use of the going concern basis of accounting and the evaluation of whether a material uncertainty exists regarding the entity's ability to continue as a going concern. Since stakeholders rely on financial statements to make investment, lending, and economic decisions, proper assessment of going concern is essential to maintaining confidence in financial reporting and corporate governance. The significance of the going concern concept extends beyond accounting measurement because it influences virtually every element of financial statement preparation. If the going concern assumption is inappropriate, financial statements prepared on a historical cost basis may be misleading, as assets may require valuation at net realizable or liquidation values and liabilities may become immediately payable. Consequently, the going concern assumption directly affects asset valuation, liability classification, depreciation policies, impairment assessments, inventory valuation, deferred tax recognition, and financial statement disclosures. Failure to identify going concern problems may expose investors, creditors, employees, and regulators to significant financial loss. Accordingly, auditors devote considerable attention to evaluating management's assessment of the entity's ability to continue operating for at least 12 months from the reporting date or longer, where required by the applicable financial reporting framework. A comprehensive going concern review is necessary because business conditions can change rapidly due to economic downturns, financing difficulties, technological disruption, litigation, or operational failures. The review enables auditors to determine whether management's use of the going concern basis remains appropriate and whether sufficient disclosures have been made regarding significant uncertainties affecting future operations. Effective going concern reviews also support corporate governance by encouraging management to assess liquidity, solvency, financing arrangements, and strategic risks on a forward-looking basis. The review therefore enhances transparency by informing users of financial statements about circumstances that may threaten the entity's future viability and influence economic decision-making. The responsibilities of management and auditors regarding going concern are distinct but complementary. Management bears the primary responsibility for assessing the entity's ability to continue as a going concern and preparing financial statements using an appropriate accounting basis. This assessment should consider expected cash flows, financing facilities, business plans, market conditions, operational risks, and other relevant information covering at least the foreseeable future. Where significant uncertainties exist, management must provide appropriate disclosures explaining the nature of those uncertainties and the assumptions supporting continued operation. The external auditor's responsibility is not to guarantee the entity's future survival but to evaluate management's assessment, obtain sufficient appropriate audit evidence, determine whether material uncertainty exists, and assess whether financial statement disclosures are adequate. The auditor must maintain professional skepticism throughout this evaluation, particularly where significant judgment or optimistic assumptions are involved. Auditors should remain alert to indicators that an entity may not be a going concern, as these may signal the existence of material uncertainty requiring further investigation. Financial indicators include recurring operating losses, negative operating cash flows, net current liability positions, inability to repay borrowings when due, loan covenant breaches, excessive dependence on short-term financing, deterioration in liquidity ratios, and adverse financial trends. Operational indicators include loss of major customers or suppliers, labor disputes, significant management departures, technological obsolescence, production interruptions, or inability to obtain essential raw materials. External indicators may include adverse economic conditions, regulatory changes, withdrawal of banking facilities, legal proceedings, loss of government support, natural disasters, or industry decline. The presence of one or more indicators does not necessarily mean the entity will fail but requires additional audit procedures and careful professional judgment. When indicators of going concern uncertainty are identified, auditors perform a range of going concern review procedures designed to evaluate management's assessment and obtain sufficient appropriate evidence. These procedures include reviewing management's cash flow forecasts, budgets, and financing plans, evaluating assumptions underlying projected revenue and expenditure, examining subsequent events occurring after the reporting date, inspecting loan agreements for covenant compliance, reviewing board minutes and strategic plans, obtaining written representations from management, and discussing future financing arrangements with lenders where appropriate. Auditors also analyze liquidity ratios, debt maturity profiles, working capital trends, and post-year-end trading performance to assess whether management's forecasts appear reasonable and achievable. Where significant estimation uncertainty exists, sensitivity analysis may be performed to evaluate the impact of alternative assumptions on projected financial performance. Appropriate financial statement disclosure is essential where material uncertainty relating to going concern exists. If management concludes that the going concern basis remains appropriate despite significant uncertainty, the financial statements should disclose the principal events or conditions creating uncertainty, management's evaluation of those circumstances, and plans designed to mitigate the associated risks. Such disclosures enable users to understand the nature and potential financial consequences of the uncertainty without necessarily implying imminent business failure. Conversely, if management intends to liquidate the entity or cease trading, the financial statements should not be prepared on a going concern basis and should instead adopt an alternative basis of accounting appropriate to liquidation circumstances, together with full explanation of that basis. The findings arising from the auditor's going concern review have important reporting implications under ISA 570. Where the auditor concludes that management's use of the going concern basis is appropriate and disclosures regarding material uncertainty are adequate, an unmodified opinion may be issued together with a separate section entitled Material Uncertainty related to going concern, drawing users' attention to the relevant financial statement disclosures. If adequate disclosure has not been provided despite the existence of material uncertainty, the auditor should express a qualified or adverse opinion, depending upon the significance and pervasiveness of the omission. Where management inappropriately prepares financial statements using the going concern basis when liquidation is unavoidable, an adverse opinion is normally required because the financial statements are materially misstated. In exceptional circumstances where sufficient appropriate evidence regarding going concern cannot be obtained, a disclaimer of opinion may be necessary. The evaluation of going concern represents one of the most judgmental areas of external auditing because it requires assessment of uncertain future events rather than historical transactions alone. Through careful analysis of financial indicators, operational risks, management forecasts, financing arrangements, and subsequent events, auditors provide valuable assurance regarding the appropriateness of the going concern assumption while enhancing the transparency, credibility, and reliability of financial reporting for all stakeholders.